I'll take you on this video from maybe you don't know nothing about market makers models to be able to understand fully and also to be able to execute interesting trades. This is a full pre-course on market makers model strategy. This is going to be a bit long, but I decided to just do it at the initial part. So like to benefit from it. So this is just one part of the course. Make sure you watch the other part of the course. Let's get into it. So the first thing that we start with is this pre-course. What is MMXM? So MMXM is an abbreviation of market makers models, and then the X could be either sell or a buy. So you could market maker sell model or a market maker buy model. The market makers sell model, we are being bearish and we enter short positions. The opposite for the market makers buy model. So that's what we need to know as of now. This abbreviation. Then we can go in details and much deeper into the details of how we can actually utilize and capitalize from this specific setup, which is one of my favorites ICT setups, as well as most of ICT's himself favorite setups. Now, one note before we go into the video is that we're going to be explaining and not going over the drafts of buy model. We're going to be discussing about the buy model, but if you want the sell model, we'll just do the opposite, okay? Flip it upside down and you have a sell model. We're going to be focusing on a buy model, not to waste any more time, guys, okay? So MMXM, in this case, market makers buy model, we're buying from here and we're going up from here, right? So market makers buy model consists of two curves, the sell side curve and the buy side curve. Each curve has different stages, right? So each market makers model consists of some phases. One of those is the original consolidation, which you should be aware of. So simply the first thing we need to identify in a market maker model is the original consolidation, which you should know where this session should be. And we should be going to go on details on how to identify this and how to identify this and go into details. And people that we first start out with the original consolidation. We have a push to the lower side and then ranged, we push lower, and we have a range. And then, but you know that price could be either consolidating or trending, right? So we move from a trend to a range, and then a trend, an expansion to a range, and then we go lower. So like this is the sell side of the curve. In this case, we have the original consolidation, distribution, and redistribution. And it could have different numbers of stages, right? Because when it comes to distribution, it doesn't need to be 2, it doesn't need to be 3, any number of stages could be valid. And when we come lower, but then when we reach a point of interest, let's say a fair value gap or break a block or imbalance, we have a liquidity sweep into that higher time frame PD array. We can then anticipate price that maybe going to the upside. But before that, before we go into here, there's only the smart money reversal. So this is a zone where we can actually anticipate the change in the state of delivery, right? Instead of having the sell side of the curve, after this market money reversal happen, you can anticipate the price going to the buy side curve. So what's the importance of significance of this, the sell side curve? What does it do? So what it does is engineers liquidity. As we're coming lower, what do we have? We get liquidity created here on the top, equal highs, becoming lower. And as we're going lower, what do we create there? Another high, another high. All those highs are created for the future to be taken. So that the future, they're going to be using those liquidity levels to be taken. In original major consolidation. This is where the market makers buy model started. We can enter from there, and this is where it ends after price hitting the original consolidation liquidity pool. So one significant or importance of the sell side curve in this case is to engineer liquidity. The other one is simply approaching a point of interest or PD array on a higher time frame. After that, we look for the smart money reversal. So we're going to be going deeply into the original consolidation. What are the different types of consolidation and how to identify some confluences in order to look for the best reversal spot, so you can spot it accurately. So what we see here is liquidity sweeping to higher time frame PY and the PD array here, and we can see that we're actually going lower until we have the change of state delivery and the market session. There's this market structure shift, liquidity sweep here, and also a creation of a fair value gap. Now, when we create the fair value gap here, this just tells you a story. And why? Because as we're coming lower, you see we're coming lower, go lower, and we have fair value gaps here, fair value gaps here, but we're not being aligned with the higher time frame. So maybe there's a higher time frame for fair value gap here, but then price trades it too, creates a new one. So the alignment is to the lower side. The time we have the alignment is high time frame point of interest going up, actually pushing price higher, and then a bullish fair value gap on a lower time frame. But now we have two things aligning with each other, and that's where we should trade from. So point of interest, high time frame going up, fair value gap after a market maker's break of structure. So this is what we call a low risk buy. Could be right here when you have the creation of an FVG immediately after the HTF POI, smart window reverse. So you can also enter state and exchange delivery somewhere there, a lower time frame. Now it's going up. We have another accumulation phase where I can only enter from, right? So this is the first type of entry, which is the lower risk buy. We're going up. We have another break of structure. This is another liquidity level that is being taken by the upside. And before reaching this level, what happens is it become lower. Might have a fair value gap here. And what we see happen is a sweep into a fair value gap or any type of entry, which is just a fair value gap by itself. But there's an entry here. We can actually enter, and it could be here. Second one could be here. And then the reaccumulation entry, break of structure to the upside, coming lower, and we have sell side taken here. Fair value gap or a narrow block, or an old high, which is the overlapping of high, maybe an overlapping fair value gap. So this is ICT's favorite emphasis. So we always talk about the reaccumulation or redistribution phase in the market make buy or sell model. So keep that in mind. So sweep here, then we stop into entering when the origin taking a consolidation is taken. What is the significance of the buy side curve? This is pretty much creating rebalancing FVGs and sweeping liquidity, right? So what we see here is fair value gap, maybe fair value gap here, and a super low liquidity, and again fair value gap, super low liquidity, and going up and approaching the original consolidation as well. So this is the original consolidation. So we have a curve, and sell side is engineering liquidity and approaching the PD array, and the buy side is rebalancing and creating liquidity and approaching the original consolidation. So we know that we're going to have another time you're going to actually be trading this. Maybe sometime you're going to trade this, but you notice that sometimes when you're entering your trade, sometimes you can actually target, for example, if you enter here on the lower risk buy, sometimes you notice that you're actually being able to target 5, 6, 7, 8 risk ratio reward, and sometimes you can only take like 2R and then it goes to a break even. What is going on? So this is something that you're gonna go take into consideration the market maker's model to see where you're entering. So if you're spot identify MMA, you'll only be able to try the higher RRR ratio, and it'll give you a higher win rate. So if you focus on market maker's model and you're able to identify it, you always take trade where from here, for example, and not targeting this or but have a clear target that actually most of the time is actually high probability price reaching it, and this will be 7 to 1, 10 to 1. That's a big trade, and again, you can actually use and capitalize on. Sometimes this corresponds to 1 to 2, 3 trades a week. Nevertheless, we initially talked about the original consolidation, right? First phase we need to identify and look for, but there are different types of original consolidation, right? So there's, the first one could be this one. We have a range. Now simply the original consolidation needs to be ranging, right? But it could be in different types and different shapes. So the first one is as price is ranging before it comes lower. Because we're having a market maker buy model, so we're looking for the smart meter reversal to all the way down. Before the price comes lower, it needs liquidity to go lower. So sometimes it's not going to go directly like shut down, but what it's going to do is going to sweep liquidity from the top, buy side liquidity, and then start coming lower. So that's the first thing. That's the first type. Second type is price creating highs and lows, highs and lows, highs and lows, and before breaking out to the lower side, it's going to go into an equilibrium of the range, This is the premium, 0 discount. This is the equilibrium, right? On your Gantt, so equilibrium of the range, there is an order block or a fair value gap, most likely, and price is going to react from it and going lower. So this is type 2. These two are high probability scenarios. A higher probability of them all is this one. So what's the difference between this one and this one? So in here we have high resistance liquidity run, and in here we have low resistance liquidity run. Instead of breaking up to the upside, we created relative equal highs, and we started going lower. In the future, when we see this smart money reversal tip type here, it's going to be a very nice target, because now we have liquidity here, more liquidity here, so it lowers, and that's what we need to actually target. We need to target low resistance liquidity, because this is where most for the liquidity is. So this could work, this could also work, but this one is amazing. Huh? This one for me is the best one. So will be continued. You guys enjoy. I'll catch you later on.